Friends, welcome back to our channel OMSAI Bhojanapalli.
Please consider two puts on the same underlying asset. The puts have the same expiration date, exercise prices of 80 and 90. If the put costs 4 rupees and 12 rupees respectively, complete the following table showing the value of and the profits on a bull spread at an expiration of these two puts. Okay, the stock prices on expiration has been given. Now, tell me there are how many options? Two options. What two options here? Put option. One put option is having a strike price of 80 and is having a strike price of 90. Answer my question. 4 rupees premium is there, 12 rupees premium is there. Yes or no? Now, 4 rupees premium is for 80 strike price, 90 strike price. 4 rupees premium is for 80, 90. Why 80? Put with a low strike price is less attractive because I have a right to sell only at 80. Hence the premium is only how much rupees? 4 rupees. And for 90 premium, what is the strike price here? 12 rupees. In the parita? No. Answer my question. I am going to go for a bull spread now. What is bull spread? Hold what? Right what? Hold low strike price and right what? High strike price. Answer my question. I am going to hold the put option with what strike price? Low strike price. I am going to write the put option with what strike price? High strike price. I hold the put with 80 rupees strike price. I write the put with 90 rupees strike price. I have an obligation to buy at 80. I have a right to sell at 90. Ennappa right or not? Yes or no? No. Should I repeat? Can I proceed? No. See, the chapter will almost look same here. The monotone, that is, if you are not alert, all words are going to seem same only throughout. You know, always I speak call option, put option, exercise, lapse, hold, write. I cannot speak any other English language now because that is what is the word used throughout. Are you following what I am saying? Now, again I say, it is in your hands for this chapter to be very alert. For to be what? Very alert. You need not come to the class here. It irritates me. Please. For whom I am teaching? Now, what? Stop joking. Understand that every listening is about stamina. Listening is about what? Stamina. I am doing entire thing on my part. How much I explain? You go anywhere. No faculty will explain. Once again, for every problem, exercise or not. Every problem, every number I ask you whether exercise or not. Correct? I am explaining every strategy elaborately. In the Samla, each time taking around 15 to 20 minutes. It is not worth taking so much time. I am doing it because you should be having a mental exercise to what? Understand. Every time a problem is done, you should think what? Afresh and tell me the answer. Now, don't be indifferent. It is very bad of you. Can I proceed or not? Now, now, 80 rupees, 90 rupees. You are holding a put with what strike price? Other number what strike price? 80 rupees. Tell me you have a right to sell at what rupees? 80 rupees. Yes or no? Now, you are writing a put with what strike price? 90. You are what? Obligation to buy at what? 90. Yes or no? You have a right to sell at 80 and obligation to buy at what? 90. Spread is for you, against you, against you. You'll make a loss of 10 in the spread always. Spread is against you or not because you have a right to sell at what? 80, but obligation to buy at what? 90. It is minus 10 spread. But 80 rupees you hold a put or not. For that put holding, you pay premium or receive premium or pay. How much you pay premium? 4 rupees. 90 put writing. You pay receive premium. How much receive premium? 12 rupees. So I am going to pay 4 rupees and receive what? 12 rupees. Net premium paid, net premium received. Net premium received. How much it is? 8 rupees. I am a net holder, net writer, net writer. I am a net writer of a put option with a 8 rupees premium. Accept or not? That's only a strategy. Can I start doing the problem together or not? Now, let's start with the solution, please. Question number 30. Okay. Open the columns quickly. Can we switch on the AC or not? Okay. Now finish opening the columns or not? Shall we start? Can I start? Now, everybody should apply their mind and tell me the number every time. Yes or no? Monotonously don't write 0, 0, 0, minus 4, 12, etc. I have to what? Apply the mind and tell me. First, 70. Will you exercise your 80 put or allow it to lapse? Answer. Solluppa. Exercise or lapse? Exercise. I have a right to sell at 80. A share worth what? 70. From this put, I get how much rupees here? 10 rupees. Put gives me 10 rupees value. Gives me what? 10 rupees value. For getting this 10 value, how much I paid as premium? 4 rupees. What is the payoff? 6 rupees. My holder has a right to sell at 90. Will he exercise or lapse? Exercise. He has a right to sell at 90. A share worth what? 70. He will exercise and he will enjoy a profit of 20. But I have to suffer a loss of 20. Because I have to buy from you how much rupees? 90 rupees. A share worth 70. Enough right? Now, tell me, in this case, premium paid or received? Received. The payoff is minus 8. 6 minus 8 gives you minus 2. 75. Will I exercise lapse? Exercise. Right to sell at 80, a share what? 75. 5 rupees. Premium minus 4. Payoff is 1. Will the other party exercise or lapse? Exercise. He sells to me at 90, a share what? 75. He makes a profit of 15. I make a loss of 15. What is the premium? 12. It is minus 3. Bull spread payoff is minus 2. 80 indifferent. The value is 0, minus 4, minus 4. Will the other party exercise? Yes. Right to sell at 90, a share worth 80. What is the profit he makes? 10. I make a loss of 10. 12 rupees premium, 2 payoff. Tell me what is the net payoff? Minus 2. Net payoff is minus 2. 85. Will I exercise or lapse? Lapse. 0, minus 4, minus 4. Will he exercise? Yes. Right to sell at 90 and share what? 85. For him the profit is 5. For me the loss is minus 5. 12. It becomes 7. 7 minus 5. What is the premium? What is the amount here? 7 minus 4. The amount is 3. Sorry. Can I continue in the next slide or not? Next. 90. Will I exercise? Lapse? Lapse. 0 minus 4 minus 4. He will exercise and lapse? Lapse. Indifferent between what? 0, 12, 12. The net premium received is 8. Now, yes or no? 95. Will I exercise? No. 0, minus 4, minus 4. Will he exercise? No. 0, 12, 12. The net premium is 8. Net premium is 8. Same thing will continue. 100. Both options will be lapse. 0, minus 4, minus 4. 0 plus 12 plus 12. Premium is 8. Net premium received is 8. 105. Both options will be lapse. 0 minus 4 minus 4. 0 12 12. The bull spread payoff is 8. 110. Both will be lapse. 0 minus 4 minus 4. 0 12 and then 12. The payoff is 8. The payoff is 8. After 90, it is copy and paste only. So everything is what? Same. I always learn how much payoff here? 8 rupees payoff. Everybody respond, yes or no? No. Let's put it in the form of a pattern. Tell me, If the FSP is below 80, all of you, if the FSP is what? Below 80, both the put will be dash. So look, stop. Tell me. If it is below 80, FSP is what? Below 80, both the put will be what? Exercise or lapsa? Exercise. One has a right to sell at 90, another has a right to sell at what? 80. Below 80, both will exercise a right. Yes or no? In that case, I am going to have a spread in favor of me against me. Why against me? I have a right to sell at 80, but have an obligation to buy at what? 90. 10 rupees against me spread. Yes or no? No. Spread is 10 rupees against me, but I receive a net premium of how much rupees here? 8 rupees. So what is the loss is our maximum 2 rupees. Now, when FSB is below 80, I suffer what? 2 rupees loss. Now, next. FSB is above what? 90. FSB what? Above 90. What happens if both the put option lapse? My 80 also lapses. Is 90 also what? Lapses. So both option will lapse. So I will be having a net premium received how much rupees here? 8 rupees. Are you follow what I am saying? So below 80, 2 rupees loss. Above 90 what? 8 rupees premium received. Below between 80 to 90, the loss becomes a profit. Yes or no? Now, my question is, what is a break-even FSP? Question is no. First of all, put option formula. What is break-even FSP put option formula? Strike price minus premium. Yes or no? Now, what is premium? A. This premium should be reduced from 80 strike price to 90. Question is no. Now, don't tell like an astrologer, I am a net writer, I am a net holder. Why net writer? Receiving 8 rupees premium. So I should adjust against what? Writing strike price only. Or writing strike price 90 rupees. Adjust, I'll be getting 82 as what? Break even FSP. Ennappa, right or not? Yes or no? Now, in that case, and this is a routine calculation. Now, you tell me, situation. Less than 80. Once again, repetition. Don't get irritated. Tell me, less than 80. What is status? Loss or profit? What is the loss? How 2 rupees here? Spread loss is how much? 10. Net premium received 8. Net loss is what? 2. Above 90, what is that? Profit. What is the profit? Net premium received 8. Between 80 to 82, I'll be having what? Loss. Now break-even FSP is what? 82. After 82, I start making profit. It touches 8 peak and what? 90. Then what touches 8 and then becomes stabilized. Response is or no? Now. We look at that diagram, same shape only. Shape is what? Same only. That is also like a snake. This is also like what? A snake. The snake is like a snake. Yeah, snake is like what? A snake. Only thing is, here the snake is a taller snake. That is what? The shorter snake. Because here the premium is what? 8 rupees. The profit is only how much? 2 rupees. Everybody is or no? Now, know one thing. Both the spreads are called as bull spread. Both are called as what? Bull spread, because the person can make profit only when the FSP is higher. Yes or no? There he makes 2 rupees profit, here he makes what? 8 rupees profit. In both the cases, he can make profit only the FSP is what? Higher. So he expects the FSP to be more. Hence goes for what? Bull spread. This is called as bull spread with call as well as what? Put option. Respond yes or no? In both the spreads, I make a profit above what? 90 rupees. He expects the FSP to cross 90. Hence he goes for this particular strategy. Everybody, are you following or not? Now, it is spread. I want to have one small last discussion. Not for the exam, just to understand it, that's all, and then go for the next issue. Now, before that, tell me, first spread is what? Bull spread with call. Next is what? Bull spread with put option. Both the spread, the payoff diagram shape is same. What is shape here? A snake looking right hand side. Looking what? Right hand side. It is looking like this. Yes or no? Snake looking what? Right hand side. Only thing is, it all depends on the premium. Earlier it was 2 rupees. Now it is going to be what? 8 rupees profit. And both want to earn profit at what strike price? At what FSP is? Higher FSP. Hence we call as a bull spread. Are you following what I am saying? Now, the question is, sir, if a person believes that the FSP is going to be more than what? 90. Why should you go for spread? Why can't you simply go for a call option? You earn unlimited profit. Now, earlier, look at the bull spread with call. I hold a call with a strike price of 80. I write a call with a strike price of what? 90. Agility. Are you listening or not? No. Last problem. Hold a call with what? 80 strike price. Write a call with what? 90 strike price. So now, suppose I hold a call with 80. That's all. I don't write a call. Okay. In case the share price is 100, my profit is 20 rupees or not? Now, if the share price is 150, I'll be making what? 70 profit. Yeah, yes or no? In that case, why if I am a bullish person, why should I go for the spread? Why can't I simply take a call option position itself? Are you following? In a call option holder is what? Bullish. Right or not? Why can't he make what? Unlimited profit? A question arises, right or not? Now, see, who will go for a spread? A question arises, not. Person who expects the share price to increase but not leap. Leap means what? It will go from 90 to 93. That is, always people watch the share price. Every share price will be having an upper cap and what? A lower cap. They can see the trend movements. Yes or no? Now, the person believes that the share price is going to cross what? 90. It will be going to cross 90. Rather that it is going to be 100 rupees or 110 or 150. It will be something in the range of what? 90 to 93 or 94. Everybody understood what I am saying? He believes there is going to be the share price. In that case, if he goes for only call option, his premium is 12 rupees. If he goes for spread, he has reduced the premium from what? 12 rupees to what? 8 rupees. He pays less premium, hence could earn only what? Less payoff. So if he believes that the share is not going to shoot up very high, there's a very remote chance of earning 20 rupees or what? 30 rupees profit. He can say, why should I pay 12 rupees unnecessary premium? It is enough if I pay what? 80 premium. Because anyhow the share price is likely to be what? 92 or 94. Now, I'll give an example. Suppose share price is 94. Share price is what? 94. Only call option. Tell me what happens here. 14 rupees. Share price not 94. Share price is 92. What share price here? 92. Tell me 92 share price. Only call option 80 rupees strike price. Exercise and labs are exercise. What the profit here? 12 rupees. What the premium pay? 12 rupees. The payoff is 0. Come back. Spend again 2 rupees here. What I am saying now. I believe the share price will cross what? 92. In the next 3 months, it will be ranging from 92 to what? 93 and 94. Means I don't want to commit myself to what? 12 rupees premium. I commit myself to what? A spread. So that the spread will be ensuring me some profit, not make me pay what? So much premium. Even very afraid of a downside risk also. Instead of suffering 12 rupees loss, I can restrict my loss to what? 8 rupees. Every strategy is having what? Own return and risk. In a risk is less. Return also is what? Less only. Yes or not? The loss is minus 8. So the profit can be what? Plus 2 maximum. There the loss is what? Minus 12. The profit can be unlimited. If the unlimited profit chance is very high, I go for simply what? Call option. If the share is not so volatile, I can rather go for what? A spread than going for the call option or put option. Everybody understand what I am saying? So there is a logic for what? Each and every strategy. The person playing in the market should understand share price before you go for derivatives. What I am saying? Derivative market, never a person should understand without understanding what? The underlying asset market. So if you don't understand underlying asset market, surely a person will get wrong in what? Derivative segment also. Are you following us? Now that a person is specialist in what? Derivatives and weak in what? Share market. Only if you know how the TCS share price is moving, you can understand what? The TCS option prices say, you can predict prices, you can predict what? Trends. Otherwise, if it's ignorant about share market, do not enter what? Option, because option is a derivative that derives its value or payoffs only from what? The underlying asset. It's not how the asset behaves, so do what? The derivative also gives you the payoff. Everybody, are you following what I'm saying? The clarity is good? Now, so up to what you have copied here? All this overall. Now, please copy this quickly. Now, this you copy in the workbook. Don't copy in the notebook. Workbook space copy in the workbook. Finish copying, huh? Can I proceed? Finish copying, huh? Finish copying, huh? Shall I proceed? Now, write down, note. Point number 1. For put option, break-even FSP is equal to, for put option, break-even FSP is equal to, for put option, break-even FSP is equal to what? Strike price minus premium. Break-even FSP is equal to strike price minus premium. Point number 2. In the above problem, the investor is receiving net premium. Am I correct? Huh? In the above problem, the investor is receiving net premium. The investor is receiving net premium. Hence, I want to fill up the blanks. Hence, it is what? Net writer. Correct? Receiving premium, hence it is a net writer. Hence, he is a net writer. Receiving net premium, hence he is a net writer. We should adjust from the writing strike price. 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 Right, next line. BEFSP, break-even FSP is equal to, break-even FSP is equal to, break-even FSP is equal to, what minus what? 90 minus 8. 90 minus 8 is equal to 82. 90 minus 8 is equal to 82. Is equal to 82. Everybody, are you following or not? Now, next, copy this diagram. Same as previous, tell me where it cuts the x-axis. Tell me this point is what point? 82. Below 80, it is a loss of 2. Above 90, it is a profit of 8. It cuts the x-axis at 82. Please copy this diagram quickly. Don't draw as elaborately as the slide. Let's put in the Excel. Just or snake money put it. What do you do? Where the snake cuts the x-axis, put as what? 82. And the tail flattens at what? 80. Hood flattens at what? 90. That's all. Finish copying up. Those who are not copy, raise your hand. Please, quickly. Finish copying, huh? Okay. Now, very slowly we are doing, but again, no, there should be no confusion. Everything should be having clarity. Okay. Don't get irritated. Let us once again understand how really things happen. Okay. See. Now, suppose you are wanting to create a bull spread. You want to create what? Bull spread. Let's see practically really how it happens. Okay. How the money is received or paid. Now, all of you listen. You are a person who are an investor. You want to create an option called as what? Bull spread with what option? Put option. Let's take the same problem. Yes or no? Now, please. You first go into stock market. Go into what market? Stock market. On the stock exchange portal you enter. In then there are two segments. One is what? Share. Another is what? F&O segment. Ennappa, right or not? Now, you will enter share segment. F&O va? You go for what? F&O. In the futures is there, options is there. Where you will click? Option. Once you click the option, they'll be asking a company name. Suppose it's an option of a company called as M Limited. Option of what limited? M Limited. You click the, you just type in search M Limited. They give you what? The prices. Everybody yes or no? Now, I see two put options of M Limited. How many options here? Two put options of M Limited. One is a M Limited put option with a strike price. How much here? 80. Another option is strike price of what? 90. Like two shares. These are two options. Are you understand what I'm saying? Both are different options here. Strike price of 80 and 90 and what? Two different options. You see two options in the screen. One is an option with what? 80 strike price. Another is option of what? 90 strike price. For both they have two boxes. Buy as well as what? Sell. I have to tick one of the boxes. Are you understand what I'm saying? Now, tell me. 80 option is that, 90 put option is that, M Limited shall be having four options. What are four options here? Call, put. With 80, 90, 80, 90. I want to create with a put option spread. Yes or no? Now you tell me, you will put a tick against buy order, sell order for 80. You are going to hold what? 80. You are going to put a buy or sell, buy. I just click what? Buy order for 80. Yes or no? Now. And the screenless price is shown. What the premium is shown here? 4 rupees. Now, I click a buy order for how much premium? 4 rupees. Now, and I also another do what? Sell order. I click for what? 90. And the premium is how much rupees here? 12 rupees. Yes or no? Immediately, these are two orders I place. My other counterparty need not be the same person. I am only creating spread here. Other party can be going for an individual option also. Yes or no? No. For me, there are two counterparties. As a holder, there's going to be a writer for 80. As a writer, there's going to be a holder for what? 90. And I have entered into a contract with two parties. I don't see them because I go inside the stock exchange. Are you understand what I'm saying? Now, what happens is, how many persons are involved? 3 persons. Myself and my writer and what? My holder. Respond yes or no now. In that case, immediately in my bank account, I receive how much rupees? 12 rupees credit for the option return. I also have to pay what? 4 rupees debit. Two transaction comes in a bank passbook. One is what? 4 debit and then what? 12 credit. My passbook with the 80 rupees credit net premium received. Yes or no? All this happens today itself. Right or not? Suppose the option is for 1 month. Option is for what? 1 month. After 1 month, suppose this is going to happen. After 1 month, this is a put option. After 1 month, I go for this to understand much more better. The share price is 75. What is share price here? 75. Yes or no? Now, already in my bank passbook, 8 rupees is there. That is the amount that has been already received. After 1 month, the share price, how much is here? 75 rupees. Respond yes or no? Now, see, I am a holder of a put or not? Now, I have a right to sell an asset. How much rupees here? 80 rupees. What? 75. That means exchange gives me a notification that from the put holding you have made a profit of 5. Yes or no? Now, What the stock exchange does, it is going to debit the counterparty bank account with what? 5 rupees and credit me with what? 5 rupees. I'll be receiving 5 rupees in my hand. Everybody, are you following what I'm saying? After 1 month, I receive 5 rupees because my share price is 75, but the put is having a strike price of what? 80. I have a right to sell at 80. Yeah, share worth what? 75. Rarely delivery take place. The exchange intimates both parties saying that your account will be debited with 5 rupees and he should be get with what? 5 rupees because I have made a gain, he has made what? Loss. Or speculation, yes or no? In that case, I get 5 and he loses what? 5 rupees. In my bank, 5 rupees comes, yes or no? Now, another intimation comes from the stock exchange. What it says that what? That is also I have return option with what? 90. I have agreed to buy at 90. Yes, I want what? 75. The exchange says, please pay me 15 rupees. I pay the exchange what? 15 rupees. You credit the 15 rupees to what? Other party. So, at the end of the 1 month, I pay 15. I receive what? 5 rupees. My past week is having a net debit how much rupees? 10 rupees. Already 1 month back I got 8. Now I paid what? 10 rupees. Ignoring time well money. How much I earn from the market? -2. Everybody, yes or no? That is how it works. For others, no need to go to share market. Nobody is buying share, nobody is what? Selling share. If delivery is insisted, then what I can do is I have to do one more transaction, buy and deliver. That's all. Yes or no? And only extra transaction is what? Instead of knocking off, I have to want to buy and deliver and then what? Get and sell. Are you following what I am saying? In that case, it is going to happen. One extra amount is what? Brokerage may be paid on what? Buying or selling. That is why mostly people to avoid brokerage, 90% of the option contract as well as later futures contract don't get settled through what? Delivery. They always get settled through only what? Netting off only. Are you following up? In the discussion, clarity because it is not possible to explain everything in one word, not in one class. As opportunity comes, I keep on what? Including how it really works. In the last class of the option, I will show you really what? The option contract screen in the stock market, how to read the numbers. Are you following or not? Now, do you understand how normally things work or not? Now tell me, mostly delivery will take place or will not take place? Suppose the strike price is, suppose the share price is what? 70. I am holding put with what? 80. Tell me, will I sell at 80? Will I give a share and get 80 rupees? No. What happens? Anyhow, I have to buy at 70 and give at what? 80. Exchange, give me 10 enough. All I said, receive what? Take what? 10 rupees. Anyhow, you are going to buy at 70 and sell at what? 80. What you are going to have is only what? 10 rupees. Take 10 rupees. No need to have what? Buying and selling. Other party what? Give 10 rupees. Debit this bank account 10 rupees and credit my bank account how much? 10 rupees. The transaction is settled. Who does all these things here? Stock exchange. Are you following what I am saying? Stock exchange, it is possible to settle without what? Delivery. And this is more complex. We will discuss it in the future. Where the entire time will not be received in one day. It will be received over what? The entire option period through a procedure called as mark-to-market procedure. We will be discussing it in the future chapter later. Everybody, are you following or not? Now, I am not discussing one sum. Wherever opportunity comes, I try to explain how the things really work for you to have a clarity. Now, you should not ask the question once again, sir, I don't have a share. How I can go for what? Put option. Don't worry. You need not, even a beggar can go for what? Put option. Because he need not have that share. Yeah. He needs to have only 5 rupees or 10 rupees. Now, because there is no need to buy the asset, no need to invest in what? Asset. I am only betting. It is simply what? Betting only and trading on a better transaction. Everybody following what I am saying? Now, next. Take question number 14. Okay. Now, not to lose track, we are discussing about the concept called as what today? Spread. Spread na you are a holder or writer. You click a buy button or sell button or both are both. You can be having a spread with what? Call option as well as what? Put option. Two spreads are over. Two spreads here. Bull spread with call and then what? Put option. What is bull spread here? You hold a call with a low strike price. Write a call with the high strike price. Hold a put with the low strike price. Write a put with the high strike price. In both the spreads, what's the common thing here? I will make profit at higher of a space. I will lose money at the lower of a space. Both are bullish and want this particular spread transaction. Response yes or no. Spread may not give me what? Bumper profit, but also awards me what? Losing a big premium also. Following now. Can I go to the next stage? Now, take question number 14. Take question number 14. Now what happens here? AC off or on? Take question number 14. Okay. Now, those who are all awake, raise your hand. Okay. Put the hands down. Now, I will not ask this question in the next class and all because when you go to valuation model, it will be more concrete and what crisp for discussion. But here the problem is, I can understand your question. Call option, exercise, labs, say pay of 5, -4, 10. You'll be getting immune to what? Numbers. Everything looks what? Similar only. It may think so, but there only your ability and what? Agility required. Think, concentrate, hard. Can I proceed or not? Now, if you lost 1 or 2 numbers here, what you should do? Go home and redo the sum. Can I proceed? Now, yes or no? Take question number 14. Consider 2 calls on the same underlying stock. Call have the same expiration date. Exercise price 80, 90. Call cost 12 and not 14 lapa 4. Wrongly typed. Call cost 12 and then 4. 12 and 4 respectively. Complete the following table for a bear spread. Okay. Now, let us do it quickly together. Now, what is bear spread? Tell me. Hold with high strike price, right with hold low strike price. Yes or no? Tell me. I am going to hold a call option with the strike price of how much rupees? 8. A strike price of 90. I am going to write a call option with strike price of what? 80. I am going to pay premium for 90 rupees strike price. I am going to receive premium for what? 80 rupees strike price. Accept or not? Now, 12 rupees premium is for 80 or 90? 80. 4 rupees is for what? 90. And a call premium is more when the strike price is what? Less and so on. Are you able to understand or not? Now, tell me, I am going to pay how much premium? Now, I am going to hold a call with what strike price? 90. I am going to pay how much premium? 4. I am going to receive how much premium? 12. And I am writing a call with what? 80. Receiving 12 rupees premium. I am holding a call with what? 90. Paying 4 rupees premium. I am a net payer, net receiver. Net receiver, how much premium? 8 rupees. Ennappa, right or not? This strategy is almost same as a previous strategy. Bull spread with put option. Any opinion what I am saying? Bull spread with put option is almost similar to what a bear spread with call option. Right or not? Now, both are going to have a same payoff strategies. Can I start or not? Now, let's do it together. Now, we should be having more vibrancy, more speed also. Okay, now. Okay, now. Bear spread with call option. Okay. Copy the headings quickly before I start. Question number 14. Question number 14. Please. Shall we start or not? Finish opening the headings now, one by one. First, shall we start? Okay. See, first. FSP 70. You are writing with the strike price. I just forgot to write. Call writing. Bracket write how much? 80. Call holding with 90. Writing 80. Holding with 90. Before that, tell me, you have an obligation to sell at how much? 80. You have a right to buy at what? 90. Basically, a spend is against you or towards you or against you. You have an obligation to sell at 80. You have a right to buy at what? 90. You are having a minus 10 spread against you. For that, you are receiving what? A premium of 12. That is a premium of 8. Are you following what I am saying? Now, let's start with the solution. 70. Now, will the holder exercise a lapse? Exercise a lapse? Lapse. So value is 0. I receive a premium of 12. The payoff is 12. Will I exercise a lapse? Lapse. 0 to a minus 4, minus 4. I pay a premium of minus 4. The payoff is minus 4. Then mid payoff is 8 rupees. 75. Will my holder exercise a lapse? Lapse. Anything below 80 will be lapsing at yes or no? Here lapse. What the value of call? 0. I receive 12 rupees premium, payoff 12 rupees. And will I exercise a lapse? Lapse. I will never exercise unless it crosses 90. Yes or no? In the case what? 0, minus 4, minus 4. Payoff is what? A. Next, 80. Will my holder exercise a lapse? Lapse. That is what? 0, 12, 12. Will I exercise a lapse? Lapse. 0, minus 4, minus 4. Payoff is A. All of you alert, away. 85. Will my holder exercise a lapse? Exercise. He has a right to buy at 80. Yes, I want to 85. He has made a 5 rupees profit on the contract or not. What the stock agent will do, he will debit my account with what? 5 rupees and credit his account with what? 5 rupees due to the option writing. Yes or no? In the case, what happens here? Minus 5. Already I got how much premium from him? 12 rupees. Ultimately, I earned how much rupees? 7 rupees. In this case, will I exercise a lapse? Lapse. 0 minus 4 minus 4. The profit I earn is 3. The profit I earn is 3 rupees. In here, right or not? Now, next. Can I go to the next slide? Now, 90 rupees. Will the writer exercise a lapse? Exercise. He is having a right to buy at 80. Yes, I want to at 90. My account will be debited by the exchange by 10 rupees and his account will be credited by 10 rupees. Already from him I received how much premium? 12 rupees. The net amount I earn is 2 rupees. Now, as a call holder, I will exercise a lapse. Lapse. I will pay how much? Minus 4. It is minus 4. It is minus 2. 95. Will my holder exercise a lapse? Exercise. He will gain how much? 15. I will lose minus 15. I received 12. The payoff is minus 3. The payoff is minus 3. In this case, I will what? Exercise. I'll exercise and get how much rupees? 5 rupees. And how much I paid? Minus 4. Payoff is 1. Minus 3 plus 1, minus 2. 100. Will he exercise? Yes. He earns 20. I lose 20. I received 12 premium. What a net payoff? Minus 8. Here will I exercise or not? Yes. I have a right to buy at 90 a share worth 100. Exchange gives me how much I pay? 10 rupees. And how much premium? Minus 4. The payoff is 6. Minus 8 plus gives 6 gives you what? Minus 2. 105. Exercise and lapse exercise. And he earns a profit of 25. I lose 25. 12 minus 38. Here I exercise and make a profit of 15 minus 4, 11. The bull spread, bear spread payoff is minus 2. Last number is 110. It is what? 80 minus 110 minus 30, 12 minus 18. Next is what minus what? 90 minus 110, 20 minus 4, 16. It is minus 2. It is minus 2. Everybody, are you having the clarity or not? Now, write down. Next. Copy the slide quickly. It is same as bull spread with put, except the sign has changed. That is plus 8 plus 8 plus 8 and so on. It becomes what is minus 8 in that, it becomes what? Plus 8. And plus 2 it become what? Minus 2. That's the only change. Finish copying up. Please, quickly. Can I proceed? Okay, write down. FSP range, payoff. I have two columns, FSP range and then payoff. Please. FSP range and then payoff. My first question is, FSP below 80, all of you tell me FSP below 80, both option will be exercised or last. That means I enjoy what? A premium of 8. Write down FSP, right? Below 80. FSP less than 80. Range, right? FSP less than 80. FSP less than 80. Tell me what is the number? Profit of 8. Profit of 8. Due to, answer, why due to what? Net premium received. Profit of 8 due to net premium received. Due to net premium received. Next. FSP greater than 90. FSP greater than 90. When it is greater than 90, both of us will exercise a call or not? Yes. In that case, profit or loss? Loss. What the loss here? 2 rupees. In that right? Loss of 2 rupees. Loss of 2 rupees. How I got 2 rupees loss here? Right? Spread is equal to, answer me, spread is equal to what? Minus 10. Why spread is minus 10? I have a right to buy at 90. Obligation to sell at what? 80. Spread is minus 10. Next, premium received. What is premium received? 8. Premium received is 8. Spread is minus 10. Premium received is 8. Hence, I have to want this, that is minus 2 as the payoff. Can I proceed now? Next. Third, we have to write down now. For that, you should tell me the calculation. 80 to what? I mean, question is 80 to what? The number. Now, listen here. This is a call option or put option? Call or put option or call option. What is the formula for break-even FSP for call option? Strike price plus premium. The premium is how much rupees? 8 rupees. I should add it to 80 or 90. A question arises not 80 or 90. Rumba simple. Now ask the question. Premium received or premium paid? You are a net writer or net holder? You go for what? Writing strike price. What is writing strike price? 80 rupees. It becomes what? 80 plus 8, 88. Yes or no? Now write down FSP 80 to 88. FSP 80 to 88. Think and tell me 80 to 88 profit or loss? Profit or loss? Profit. Why profit? And at 89 becomes what? Loss. 80 to 88 profit. 80 to 88 profit. Break even FSP at 88. 80 to 88 profit. And break even FSP at 88. And break even FSP at 88. Break even FSP at 88. And at 89, I'll be having a loss of minus 1. 90 will be having a loss of what? Minus 2. Then get settled. Everybody following or not? Now, diagram I'll leave you to draw on your own. No need to waste time. Can I proceed or not? Now, right, the next question. Take question number 15. Take question number 15, please. Now, consider two puts on the same underlying stock. Put have the same expiration date, exercise prices 80 and 90. The put costs 4 and 12 respectively. Complete the following table showing the value of and the profits on the basket at expiration using the two puts. They given you the numbers. Now, answer me. First of all, the two options, call or put option. Put option. Tell me put option, what are the two put options here? 80 and then 90. Now, you are going to go for a bull spread, bear spread. We are going to hold the put option with what strike price? 90. Write the put with what? 80. Because hold the high, right low is a strategy. Accept or not? No. When you hold with 90, for the 90 strike price, you have to pay a premium. How much rupees? Yeah, 12 rupees. And when you go to right at it, you want to see a premium. How much rupees? Yeah, 4 rupees. The net premium paid or net premium received or net premium paid. How much rupees? Yeah, 8 rupees. Can you go for the pay of calculation or not? Can I proceed? Like question number 15. Question number 15. Okay, open the columns quickly and please write, put writing, bracket, how much? 80. Put holding, 90. Put writing 80, put holding is 90. Answer my question, spread is against me, spread is for me. Spread is against or for me. Tell me, I have a right to sell at what? I have a right to sell at what? 90. Everybody has a right to sell at what? 90. And I have an obligation to buy at what? 80. That means I'm having a spend against me at for me. For me. How much is here? 10 rupees. For which I pay a premium. How much rupees here? 8 rupees. The logged in amount is 2 rupees. Ennappa, right? Now, shall we start? Now, if you want, I'll stop this sum. I'll go next stage. Or if you want, you can do together. I don't want indifference. I want participation. People are not answering. What is the problem in answering question? Tell me. First. All sides I'm asking here. Now. See. You have to learn like a child. First understand. You have to learn like what? A child. You should not be thinking too mature while learning. Otherwise you will never learn. I can say. When I ask you to answer with zeal, with enthusiasm, one should answer it. I am writing a put option with what strike price? 80. Put in the mind or not? 80. I am holding a put with what strike price? 90. Okay, now you get immune now. What is holding with 90? I have a right to sell at what? 90. I have what? Obligation to buy at 80. I have a right to sell at 90. Obligation to buy at what? 80. The spread is against me or for me? How much is for me? 10 rupees. Is accepted or now? To get this spread, I received a premium, paid premium. I paid a premium of how much rupees are holding a put? 12 rupees. I received how much premium? 4 rupees. 8 rupees I paid as what? Net premium for getting the spread of 10 rupees. In this you have to see what the payoffs. Can I proceed or not? Now, my next question is, should I be a writer and a holder for the same person, different person or different person? I just go into the exchange, click a buy order and then what? Sell order. I click a buy order for a strike price of 90. I click a sell order for a strike price of what? 80. And for this buy order, they debit my account with how much rupees? 12 rupees. For this, I credit with how much rupees? 4 rupees. Immediately, I'm going to have what? 8 payment today itself. Everybody, yes or no? After 1 month, whatever happens to what? FSB, I'll make a net gain or net loss and a spread payoff. Everybody understanding it or not? Now, so last sum, okay, don't get afraid. Okay, now, 70. So what I will do? I will do or he will do? May holder only one decide. He has a right to sell at 80. Yes, I want to want 70. Exercise or labs are exercise. And he will be getting how much rupees? 10 rupees. I will lose minus 10. Yes or no? Start writing together. Minus 10. Premium is received or paid? Received. How much received? 4. Payoff is minus 6. I have a right to sell at 90. Yes, I want to want 70. Exercise or labs are exercise. I receive how much rupees? 20 rupees. What the premium paid? 12. What the payoff? 8. Net payoff is 2. Net payoff is 2. 75. Tell me, will my counterparty exercise or labs are exercise? Right to sell at 80, Shamad what? 75. And he will exercise. He will take from me how much rupees? 5 rupees value. I have received how much premium? 4 rupees. Payoff minus 1. I have a right to sell at 90 as I have 75. Will I exercise? Yes. Receive how much rupees value? 15 rupees. What premium paid? 12. The payoff is 3. What is the net payoff? 2. 80. Will my counterparty exercise or lapse are indifferent? Even exercise or what? Lapse. What is the value? 0, 4, 4. Will I exercise or? Yes. Share worth 80, I consider 90. What the value? 10. What the premium? Minus 12, minus 2. 4 minus 2 is what? 2. 85. Will he exercise some? No. Lapse. 0, 4, 4. Will I exercise that? Yes. Receive 5 rupees value, pay 12 rupees premium, minus 7. What is the value? Minus 3. Value is minus 3. Can I proceed now? Am I yes or no? No. Next. You can continue in the same slide. 90. Will he exercise the lapse? I think there is a wrong typing there, yeah? But you have written correctly in the heading or not? Now, let's put writing. Okay. Will he exercise a lapse? Lapse. 0, 4, 4. Will I exercise a lapse? Lapse. 0, minus 12, minus 12. Payoff is minus 8. Copy paste. Now, after 90, both of us will be what? Lapsing the put option. It is what? 95. My writing put is 0, 4 received, 4 taken home. And 0 put value, 12 paid, and 12 given out. What is the premium? Minus 8. 100. 0, 4, 4. 0 minus 12, minus 2, minus 8. 105. 0, 4, 4. 0 minus 12, minus 12, minus 8. 110. 0, 4, 4. 0 minus 12, minus 12, minus 8. 0 minus 12, minus 8. Up to this, everybody understanding it or not? No. Can you write the last slide or not? Write down the range and payoff. Range and payoff. Range and payoff. Have two columns, range, payoff. Range, payoff, or range status, both are what? Same. Range and then payoff. Answer my question. FSP is less than what? 80. FSP less than 80. Less than 80, profit or loss or? Write down. Profit of rupees 2. Profit of rupees 2. Full stop. You should know the reason or not. Now, why 2 rupees profit here? Spread is equal to. Spread is what? Plus 10 or minus 10? Plus 10. Spread is 10. And I have an obligation to buy at what? 80. Right to sell at 90. Spread is plus 10. Premium paid. Premium paid. How much rupees? Minus 8. Premium paid minus 8. Understanding now. Second. FSP greater than 90. FSP greater than 90, what I will do? Both will allow the put to what? Loss. So what is the profit and loss? Loss. Write down loss. How much rupees loss? 8 rupees. Loss of 8 due to what? Net premium paid. Loss of 8 due to net premium paid. Loss of 8 due to net premium paid. Can I proceed now? FSP 82. 82 what? 88 or 82 or? 82, 82. 82, 82. Stop writing. All of you tell and then write. Participate. This is a call or put. Put. What a break even FSP of put option? Strike price minus premium. Now the two strike prices are 80, 90. 80 minus premium, 90 minus premium. Question is no. Now tell me. Before answering, I am a net holder, net writer. Net holder, net writer, net holder. I pay premium, no? And that means I have to go for what? Holding strike price. How much is that? 90. 90 minus 8 gives you what? 82. FSP 82, 82. Answer 80 into 82. What happens? Profit. 80 to 82, profit. Break even FSP 82. Break even FSP 82. Please copy this number in the workbook quickly. The expiration, position value and payoff. Finish copying up. Or above. Now, last spread is what? Butterfly spread. Please. See, with 3 prices, I am going to deal with 4 options. What here? 3 prices, 4 options. Please. Let me give an example. Say, that is a call option with the strike price of 20. Another call option with a strike price of 30. Another call option with a strike price of 40. Now, all the 3 options is on the same company shares. All the 3 options got what? Same maturity. Everything is here. But the 3 contracts difference is what? The difference in strike price. Low strike price, medium strike price, high strike price. Now, how many options I am having? 3. But I am going to enter into 4 option contract. How many contracts here? 4 option contracts. Now, very simple. I hold a call with a strike price of 20. I hold a call with a strike price of what? 40. I write 2 calls with a strike price of what? 30. This we call as butterfly spread with call option. Everybody put it back. I hold a call with a high strike price. I hold a call with what? Low strike price. I write 2 calls with what? The middle strike price. Like this, the strategy goes mean. The strategy will be called as what strategy? Butterfly spread. No. Very simple here. Now, see. I have one call option with what? Low strike price. I have 2 options with what? Middle strike price. I have one option with what? High strike price. Looking like a butterfly. Yes or no? No. I don't know. Okay, I am not drawing accurately. Okay, now. Hold, right. It's going to be what the option. Hold with the low strike price, hold with what? High strike price, and right with what? The 2 middle price. Because what spread here? Butterfly spread. Can be created with a call option as well as what? A put option. Now, these things rarely asked, just to only understand. I just given you one strategy. Now, we'll complete with this particular problem, this option strategies. Can I proceed or not? Now, the problem to do does not have the premium. Gives you only what? The strike price. So we are going to write only the value. I will not be writing what? Payoff, because I don't have the premium in that particular sum. Now, the premium will be obviously very less. It will be what? Very less, because this is a holding. I have to pay. I have to want to pay. I pay a low premium. I pay what? High premium. I receive what? 2 middle premiums. The premium should not be such a big amount. It will be what? Almost nil or what? Negligible. Hence the sum which has been taken from Hull does not have what? A premium. Has got only what? The FSPs and strike price. You have to answer the question. Everybody yes or no? Now, tell you how to know the strategy or not. Tell me, what is butterfly spread? Hold with the low strike price. Hold with the high strike price. Right with what? The middle strike prices. 2 options. I call as what? Butterfly spread. Right or not? Now, can do a problem in this regard? Now, take the last question. Question number 16. Take question number 16. Number? See, it need not be average. Middle should be what? The same one. It all depends on the premium amount also. That's what I am saying. Options are not linear. It is never what? Linear. It is low, high, and then what? Middle. What they say is one should be out of the money, one should be in the money, and one should be what? At the money. That's all. Okay. It need not be average to be at the money. Are you following what I am saying? It should be same. Okay. 2 middle writing, one is 13, other should be what? 30. Now 30 and 32 cannot be there. If it's 2 different, it becomes contrast spread. They give another name called as what? Contrast spread. Different things. Butterfly spread should be what? 2 middle strike price. Both should be what? Same only. Low and high, middle need not be what? Average always. Can I proceed or not? Now, see. Now, first let us consolidate. What is butterfly spread? Spread now I am going to be what? Holder and writer. How many options I am having? I am having 4 options. I am holding 2. I'm writing to. What two I'm holding? Low and high. What I'm writing? Middle. And middle writing should be of the same price. It should not, then I forgot, it should be what? The same price. A different, they give another name called as what? Contour spread. Are you following what I'm saying? Now, butterfly spread should be what? Same middle strike price should be that. Everybody, yes or no? Now, let's start doing the sum and they have the small notes. Take question number 16. Take question number 16. For the same underlying stock, 3 calls with the same expiration date have the exercise prices of 30, 35 and 40. For a long butterfly spread, complete the following table showing the value and profits on position at expiration. Now, they are given you the payoff column can be struck off. We cannot write. Why can't we write? Because they are not given you the premium for this sum. Strike it off and write only the value maximum can be written. Can we start or not? Now, please. Caterpillar. Can I say? No. Okay. Now, we'll involve 4 calls with 3 strike price. Hold the call at a lower price. Hold another call with what? Higher price. Write 2 calls at intermediary price. Okay. Now, can we do it together or not? Now, please open this table. Two calls I'm holding now, holding first call, holding second call, third and fourth 2 calls I'm what? Writing. Okay. Right, 1 call 1 holding, 1 call 2 also what? Holding. 2 calls I'm going to write. That can be understood. Okay. Now, shall we start now? Okay, can I start? Now, all of you think and tell me. I should hear all noises. Okay, now you create noise. Tell me. First strike price 30. If you want in bracket write 30. In bracket write what? 30. And this you write in bracket how much rupees? 40. And this write as what? 35. Just for to easily understand and tell me 30, 45, or 30, 40 and then 35. Now, I have a right to buy at 30, a share worth what? 20. Exercise or labs at labs? 0. I have a right to buy at 40, a share worth what? 25. Exercise or labs at labs? I have the other party is having a right to buy at what? 35, a share worth 20. He will exercise or labs or labs? All of us will be lapsing. The butterfly spread payoff is what? 0. Ignoring the premium. Ennappa, right or not? Ignoring the premium. Next. 25. I have a right to buy a 30, a share worth what? 25. Exercise or labs are labs. Next is what? Labs. Labs. The payoff is 0. 30 also I have a right to buy a 30, a share worth what? 30. Labs. 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 The amount is 0 everywhere. Answer my question. I have a right to buy a 30, a share worth what? 35. Will I exercise or? Yes. From the exchange, I'll get how much rupees? Yeah, 5 rupees. First call gives me 5 rupees. Second call, I have a right to buy at 40, a share worth what? 30. Exercise or labs are labs. What the payoff? 0. The other 2 parties will exercise or labs are labs. The payoff is 0. The payoff is 5. Payoff is 5. 40. Will I exercise or labs are? Exercise. I have a right to buy a 30, a share worth what? 40. How much again? 10. I have a right to buy at 40, a share worth 40. What the value? 0. Other party, look at this, will exercise or not? Now, let us see 2 persons are that. Person 1 and what? Person 2. Both having how much strike price? 35. They have a right to buy a 35 share worth what? 40. Each will get from me how much rupees? Yeah, 5 rupees. What the last for me? Minus 10. The payoff is 0. The payoff is 0. Correct? Next, 45. At 45, tell me, will I exercise or not? Yes. Right to buy a 30 share worth what? 45. What the payoff? 15. And what is that? Call holding. I'll exercise, exercise. Right to buy at 40 share worth what? 45. What is the payoff? 5. I'm enjoying 20. Happy, unhappy? May be happy, may not be happy. What happens to right area? He will exercise, exercise. He has a right to buy a 35, a share worth what? 45. Each will get from me how much rupees? 10 rupees. How much gone here? 20. The payoff is 0. Respond is or no? No. 50. What happens here? Exercise or labs are exercise. Profit is 20. Exercise or labs are exercise. Profit is 10. The other party will what? Exercise. Each make a profit of 15. What they lose? 30. The value is 0. The value is 0. It need not be exactly 0 as it seems to be here perfectly, because the middle price is what? Exactly average. Payoff need not be average. There are a lot of issues regarding the premium calculation, but this is the strategy overall regarding the butterfly spread. Everybody yes or no? Now, see, we are discussing a chapter called as what? Options. The chapter name is what? Options. In which 2 segments have been completed. How many segments completed? 2 segments. Basics in option completed. Option strategies has been completed. Now, for this option alone, I have given all the practice manual sums and all at the end of the workbook. This time I just also plan to give you the type solution for study material as well as what? Practice manual sums for this option for you to revise in one shot. Okay. Now, first of all, tell me the strategies which you have learned. What all strategies you have learned here? Long straddle, short straddle, long strangle, short strangle, bull spread with call option, bull spread with put option, bear spread with call option, bear spread with put option, butterfly spread. This is not the end. There are so many other work. There is something else covered call, something else what? Covered put, etc. All this are the other strategies that covered call and put I am discussing in the later stage during the Black-Scholes model. Please don't talk. Now, take the notebook learning objective. The next area to be discussed is called as what? Short selling. And then what? Continuous compounding. Okay, now. Short selling, we already discussed on that. Let me recap and leave it because I cannot discuss continuous compounding now. It is having a continuous discussion is required. We will discuss in the next class. Before that, 1 minute. Door close. Okay, don't go. 1 minute. Short sell. I cannot repeat this once again. Short selling. Now listen before you go. Now. Write down. Butterfly set, right? It is a strategy where, write down, notes, right? It is a strategy where we hold one call with low strike price. Is a strategy where we hold one call with low strike price, comma, another call with high strike price. We hold one call with low strike price, another call with high strike price, another call with high strike price, and write 2 calls. And write 2 calls with middle strike price. And write 2 calls with middle strike price. And write 2 calls with middle strike price. Okay. I won't take more than 2 or 3 minutes just to recap the short selling. Because when you see later, without a concept of short selling, call option will become worthless. It becomes what? Worthless. There is no use in trading a call option unless the country allows what? Short selling. Call option trades only value mainly through the concept called as short selling. For our option valuation, this concept is very, very important. What is short selling? Forget options and all. Go for share market. What is short selling? What is? No need to write. Listen only. Na? What is short selling? selling the share first and buying the share later, we call it short selling. Enna parayida not? Now, what is short selling? Selling the share first and buying the share later, we call it short selling. Just a recap. Now, tell me, that is a Mr. Yes, who wants to what? Sell the share. There is Mr. BR, who is called as what? Broker. There is Mr. B, who is going to what? Buy the share. There is Mr. L, who is called as what? Lender of the share. Generally, investment banks can act as what? Lender of the shares. Right or not? Now, see. Very simple strategy. I am believing that share price is going to fall. Share price is going to what? Fall. In a falling market, better to sell today and buy tomorrow. I can sell today at 100, buy tomorrow at how much rupees? Yeah, 90 rupees. You start in a falling market. Yes or no? Now, I want to sell the share, but I don't have the share. Yes or no? Now, I want to sell your house. I don't have your house. What I can do? Can I sell and buy it later on? Not possible. But possibly in what? Share market discussed earlier. Right or not? Now, what I do is I sell the share first and buy the share later. Now, how it is possible? Now, what I do is I give my broker a sell order. I give my broker what? A sell order. Please sell for me this particular company shares. Broker should sell or not? No. So he finds a buyer and sells what? The shares to the buyer. Yes or no? No. The buyer says, please deliver the shares to my demat account. You have to deliver the share or not? Now, broker says, please give me a share. I said, I don't have the share. I'll give you after 1 month. I'll give you what? After 1 month. I want to wait for 1 month to close my portion. Yes or no? Now, what the broker does here, he borrows from another person shares for how many months here? 1 month, and makes a delivery to the buyer of the share. Everybody, yes or no? No. Who sold the share? Yes. Who purchased the share? B. And who shares are given? L shares are given. The L is the lender of the share. For which some commission and all may be charged, you ignore the transaction cost. Can I proceed or not? Now, next. After 1 month, what happens? S goes to our market and purchases the share. And he gives it to what? Broker. He delivers the shares to the lender. Either we call what position? Short position or short selling. Yes or no? Now, in between, any dividend is declared. Very important. We'll be having some models with dividend. No, in between dividends are declared. What happens here? Company will pay the dividend to lender or buyer. He is only having the share in his demat account or not. In the register members will be having only this person's name. Will be paying the money to what? The buyer. Lender will also ask for dividend or not? Yes. He has not sold the share, only one. Given the share on loan, any income accruing is going to belong to him. Yes or no? ரொம்ப simple. I give you a cow. I give you what? A cow loan for 3 months. Okay. In between, some say cow has given what? Some calf. Okay. To whom the calf say belongs to me? Belongs to me. My cow. That is also what? My calf. Yes or no? No. Yes or no? Say my share. I gave you on what? Loan. It is my dividend. Yeah. You give me the money. Yes or no? But the company cannot pay dividend because he says, I have purchased a car, so it is going to belong to me. So who should give the dividend? Yeah, yes, should give the dividend to lender. Either we call as a dividend declared during the short selling period. This concept is going to be used left and right during what? The option valuation models. Everybody, are you following in order? So, is the concept of short selling. Next class, don't come late. I have to start with what? Continuous compound. One number. If you so same urgency show will coming back, yeah, okay. If you miss continuous compounding, don't come for 1 month. Can I proceed? Okay.
Thank you friends. OMSAI Bhojanapalli.